Most AI-related stocks make a comeback in August, and at this juncture, should we exit or to hold? To exit, it means that we believe this June-July meltdown indicates that the AI bubble has popped, and August rebound merely is a retracement, and it provides an opportunity to make the exit. But to hold, it means that we believe this June-July meltdown was simply a retracement within a broader rally. It is taking a breather before the market resumes back to its uptrend. So which is it? I will break down both scenario and assess which is more likely. This analysis is based on technical study and does not constitute financial advice. Please consult your licensed broker before investing. And I would like to do an investigation on the behavior science within the AI related stocks, because they are all highly interdependent. The AI industry functions like a circular economy. They depend on each other to function as a business to make sales, meaning that if the market is bullish or bearish, most of them should share a similar trend. However, I discovered that this is not the case. The most represented AI stock, it should be Nvidia. It makes a comeback after the July sell-off, as we could see here. But the rest, like the Intel, Micron, Qualcomm, ARMs, and many others, are not behaving the same manner compared to Nvidia, Microsoft, or Amazon. And outside of US, SK Hynix, we are seeing the similar behavior as well, that it is still under pressure with no significant rebound. But why is this happening? Yes, I believe that AI definitely is the future, and that remains true today. However, we must remember that stock prices are driven by the current worth or value, not just its future potential or technology. And if a stock becomes overpriced or overvalued at a certain juncture, it will correct to a healthier level before resuming its upward trend. What we are observing here is a divergence among the AI related stock. So what could be the reason? And let's look at the investors' concern. And these are the list of concerns by most investors. They are all valid, especially regarding the weak monetization, where massive investment are made without a clarity on the numbers of its projected ROI. And in my opinion, there's even a greater concern, which is the rising borrowing costs. Most investors assume that the money spent on AI came from its free cash flow. Until these articles, you may have already read them, and there's more and more of them. Let's look at this article here. And most of the article appear in early July with a headline surface like the AI is running on borrowed money. With rising bond yields and higher inflation rates, further interest rate hikes are expected. And that is a bad news for all these hyperscaler borrowers. And let me zoom out from all these news, and let's move on to our next segment. And if ROI remain unclear while the borrowing costs potentially to be higher, the July correction is completely justifiable. We could see here. So there was a meltdown, some 40%, some 20%. And this is what I believe. The July sell-off could be a crack of this AI bubble. And if the crack continues to spread, it may lead to further sell-off. And the fundamental that we just discussed on the ROI and the rising borrowing costs is support this observation. And this was a case study that I produced, a video case study on the 31st of July. And on the 7th minute, so this was what I presented, we observed that there was a 3 peak to the top, and then the market sell off. But however, in this tutorial, I believe at a point in time, market maybe should pull back up. But this pullback up, I'm getting ready to make the exit because of the fundamental reason that we've discussed, and also the structure. So later on, we'll do a case study all the way back to 26 years ago on the dot-com bubble. And where are we today? And so this was the three pick to the top that we discovered. We have discussed the crack happened, the market pulled up as expected, and now we are here at the crossroad at a juncture, a tough decision to make. Should we exit or to hold? And this point, let me just get back to this case study as promised. And this is a point of reference way back to the dot-com bubble in year 2000. I want you to observe very closely. We should be able to find quite a few similarity between them. Both their technical and fundamental. Let's start with the technical first. Now we saw that there was this three pick to the top formation. Then it cracked and later it retraced. And at that juncture, as it pulled back up, I could recall very clearly then that many investors became very hopeful that it should retest its all-time high. But to me, at that point in time, the fundamental and technical does not quite support this idea, and therefore I make the exit back then. So let me zoom this out here. So as of today, we saw that there was this inverted hammer. This was last Friday. So this became a pullback where I make the plan to make the exit. And then we, at this point onwards, I would say that is a calculated risk, that at this point onwards, that calculated risk to hedge or to short is Nasdaq derivative. And I believe that the month of June, which is the all-time high, it is very significant. If on any periods in the coming days, weeks, or months, if it closes above this all-time high, in the coming days, weeks, or months, if it closes above this all-time high, then this analysis that we've just discussed will have to make a change. We have to alter it. And likely, if that happens, the market should resume back to its rally. So the June high, to me, it is very significant. But for the time being, I prefer to manage this potential risk that already surfaced. If you find what I just shared is useful, please like it and save the link for future reference. And do share this with your friends. My name is Con Hao, and enjoy studying how different markets currently behave to uncover emerging trends, the potential trading market of tomorrow. Feel free to leave any comments below. I love to exchange ideas with you on what is about to come. Really happy that I stayed through this tutorial. You have many great trading weeks ahead. And what I do is, I think I just put a reference of year 2000. Dot-com bubble, you could see the similarity between the both Nasdaq 26 years ago and Nasdaq today.